Hi, I'm Kevin Flanagan, head of fixed income strategy at Wisdom Tree.
And I'm Jeff Weniger, head of equity strategy. And this is Minds on the Markets, where we go behind the scenes and beyond the trends to explore the forces impacting our markets. Inflation, this was all that we were talking about in this week's Minds on the Markets. And if you like these little 5-6 minute bits that we do here, make sure you check the archives in the Wisdom Tree channel on YouTube and check the website as well. And we have the written word as well. Now, Kevin, on this matter of inflation, we have a little bit of an issue, a societal issue, which is I'm in the business. And what do I think about? I think about the CPI, the Consumer Price Index. And we talk about inflation is X, inflation is Y. It's because the CPI reported such and such. And then meanwhile, back at the ranch, the Federal Reserve is saying, well, the CPI is one thing, but we're looking at the PCE. So how do we rectify this in doing our market analysis?
I mean, it's a great question, right? Yeah, we are getting a little bit maybe into the inflationary weeds, but you're 100% correct. I mean, CPI, the Consumer Price Index, everybody seems to know that. Wall Street and Main Street. That is the inflation number that tends to come out mid-month, so before the personal consumption figure or deflator that the Fed focuses on. So the markets pay close attention to the CPI number. I think importantly as well, Main Street does, because that is what's going to be blasted in the news, blasted on the social media, not the Fed's preferred gauge per se. But if you're looking to see what Powell and company are going to be actually forecasting themselves and what they will be basing their monetary policy decisions on, it's this personal consumption expenditure deflator, it's called, the PCE deflator.
And okay, well, you kind of went right there, right into the PCE deflator. Okay, so what's the difference between the two, and what are we starting to see? Because we used the D word in this write-up. Doesn't make a lot of the rounds, but we were just talking about the D in terms of deflator, not necessarily deflation.
Right. We're calling it deflated expectations. It's a play on the term. It's the PCE deflator. That's what it's called. That's what it's known as. But in terms of deflation, no, not looking for that at all. It's actually deflated expectations, meaning that we came into the year expecting these 6 rate cuts from the Fed, but inflation has proved to be stickier, that last mile proving to be a bit more troubling for the Fed to get down to their 2% level. So that's what we're talking about here, that it's the Fed focusing on this number, as well as, say, the bond market as we approached month end. But what we saw was, once again, the number didn't come in suggesting a renewed disinflationary type of trend. It really just didn't come in hotter than expected. And that's important, because you're trying to get a perspective. What is the market looking at before this number comes in? So we've gone from disinflation to now we're happy if the number's just not hotter than expected.
All right. Where's the street on Fed cuts this year, and where's your mind?
Well, we're going to have a Fed meeting coming up in about a week. We do get the dot plot. We get the Fed's new forecast. Yeah. I would argue that the current 3 rate cuts that the Fed had been penciling in could very well drop to 2 at this stage of the game. And I think that's probably where you want to start. I do think that we will see a renewed disinflation trend to get to the Fed's 2% target. I don't know if Powell's going to wait for that to happen. And just to give you a sense, the year over year reading at current is 2.8. So maybe 2.5 is good enough, but we may not get there until the second half of the year. That's why you get the timing, September, November, and then maybe one more cut before year end.
And so therefore, higher for longer, that's legit or not legit?
It's legit, and even when the Fed does cut rates, it's still higher for longer. If you think about where we're starting, just look at the Fed funds rate. It's 5.25, 5.5. So if you get 2 quarter-point rate cuts, that just brings you down to about 5%. So yeah, higher for longer, even with the Fed cutting rates.
All right. And I'd say, what have we done? 5 or 6 of these videos thus far. You're finding them on the Wisdom Tree YouTube channel. We write long form research, short form research. We have This is Minds in the Market, so you can find this in the written word as well on the Wisdom Tree website. I say that does it for this week, Kevin. Take care,
Sounds
everyone.
good, Jeff.